Ladies and gentlemen, good day and welcome to Satin Creditcare Network Limited Q4 and FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Viral Shah from IIFL Securities. Thank you, and over to you, sir.
Thank you, Zico. Good morning, everyone, and welcome to the earnings conference call of Satin Creditcare Network Limited. From the company today, we have Mr. H.P. Singh, Chairman cum Managing Director, Satin Creditcare Network Limited, and the senior management team. We will have a brief overview on the year and the business from the management team, post which we will open the floor for Q&A. With that, I would like to hand over to Mr. H.P. Singh for his opening comments. Thank you, and over to you, sir.
Thank you, Will. Good morning, everyone. We thank you for joining to discuss our company's fourth quarter and the financial year 2024 performance. I believe you have had the opportunity to go through our quarterly results and investor presentation. If you haven't gone through them yet, you can access them on our website or through the stock exchanges. The fiscal year FY24 stands out as a momentous chapter in our 33-year-long journey, where we've reshaped countless opportunities, redefined our trajectory, and met success in all financial and operational metrics. We witnessed growth in assets under management, AUM, recorded the highest yearly disbursement, observed robust customer addition, maintained our pristine asset quality, improved our net interest margin, reduced the OPEX ratio, and fortified our capital base, paving the way for a successful year for all our stakeholders. It's comforting to mention that we have surpassed the guided range of our standalone annual performance targets on most of the parameters, such as our AUM grew by 34% against the 25% plus guided range, NIM of 13.2% as against 12.1 to 12.5% guidance. ROA stood at 4.8% as against the 3.5 to 4% guided range. Cost to income ratio stands at 42.6% as against 45 to 50% guidance. Capital adequacy ratio stood at 27.7%, surpassing the guided range of 22 to 25%. Debt to equity ratio at 2.7x as against 3.5x to 4x guided range. The rest three are also well within guided range, which are our OPEX to average AUM ratio of 5.60% as against the 5.60 to 5.75% guidance. Credit cost of 1.44% as against guided range of 1.25 to 1.50%. And ROE that stood at 18.5% as against the 17.5 to 19% guidance. Our Punjab portfolio performance was a little dampened due to the ongoing local challenges. However, by taking timely actions, we have been able to contain the issues. Our total on-book portfolio in Punjab stands at rupees 369 crore as of March 24. Overall, PAR 1 in Punjab stands at rupees 35 crore and PAR 90 at 19 crore. Out of this, PAR 1 in the 10 affected branches stands at 23 crore and PAR 90 is at rupees 11 crore. Our collection efficiency in the state is 97% for FY24 and 92% for Q4 FY24. Currently, we have slowed down our disbursement in the affected areas and have deployed additional collection officers to engage with and motivate with the clients, and we are meeting success in that. Coming to our operational performance, we closed the financial year by recording 30% year-on-year growth in AUM, which stood at rupees 11,850 crore on a consolidated basis. On a standalone basis, the GLP stood at 10,593 crore, up by 34%. Securing the 10,000 crore milestone in SCNL was a historic moment for us this year, underscoring our clients' trust and our team's resilience and fueling our momentum forward. We continue to witness robust growth in our borrower base. We added 6.3 lakh customers on a consolidated basis and 7.8 lakhs on a standalone basis, highlighting our expanding footprint, operating efficiencies, and growing demand for our services. We recorded our highest yearly disbursement both on a consolidated and standalone basis. Consolidated disbursements stood at 10,549 crore. It grew by 30% year-on-year, and standalone at 9,691 crore, up by 31%. We forayed into two new states, Andhra Pradesh and Telangana, in line with our strategy to expand our inclusive charter to more individuals from low-income groups. With this expansion, our presence is spread across 26 states and union territories. The branch infrastructure now stands at 1,393, with the opening up of 107 new branches spread across 421 districts. The robust underpinnings of our organization, which includes our solid fundamentals, ethical work practices, customer-centric business approach, and employee-focused operational framework, have ensured our continued social relevance. As a result, we have emerged as a preferred financial ally for numerous low-income households throughout rural India. This is also evident from the healthy number of first-cycle customers at 55%. During the reporting year, we maintained the trend of our healthy collection and asset quality. The on-book GNP of the company stood at 198 crore, which is 2.5% of the on-book portfolio. The company has sufficient on-book provisions amounting to 164 crore as on March 24, which is 2.1% of its on-book portfolio, exceeding the RBI mandated provision requirement of 148 crore. Furthermore, the overall provision coverage ratio stood at 83% as of March 24, marking a significant increase from 64% recorded in March 23. The performance of the new portfolio originated from July 21 onward continues to perform better than the industry, which constitutes about 97% of the on-book MFI portfolio, with PAR 1 at 2.5% against industry PAR 1 at 5.9%, and PAR 90 at 1.5% against industry PAR 90 at 3.6%. This demonstrates the effectiveness of our underwriting processes. The collection efficiency remained consistent quarter-on-quarter for the reporting period and stood at 98.5% for the year on a standalone basis. The collection against write-off pool stood at 46 crore. We commend our dedicated field staff for their relentless efforts in ensuring successful loan recovery through persistent follow-ups and client engagement. This year, the industry witnessed a remarkable surge in credit demand from the rural market, a trend vividly illustrated in the figures of the industry's loan portfolio. The rising internet penetration, improved income levels, and evolving aspirational lifestyles in rural areas are fostering an environment conducive to sustained growth in credit demand. Furthermore, the economic forecast is optimistic, with predictions of an above-normal monsoon in the coming time, which will in turn boost agriculture productivity and disposable incomes. All these factors bring in good news for MFIs like us, who are predominantly rural, in catering to those at the bottom of the pyramid, as we further enhance footprints into this expanding market. Coming to our financials now, the company's consolidated net interest income grew by 43% to reach 1,340 crore, largely driven by robust loan growth portfolio in the reporting financial year. The pre-provisioning operating profit for FY24 stood at rupees 732 crore, registering a growth of 80% on a consolidated basis. The net interest income and pre-provisioning operating profit on standalone basis are at 1,218 crore and 699 crore respectively. Our profitability milestone touched the new mark as we recorded a PAT of 436 crore as against 5 crore in the previous fiscal year on a consolidated basis. On standalone basis, we recorded a PAT of 423 crore, up 60% year-on-year from 264 crore in the previous fiscal year. Our OPEX to average AUM ratio witnessed significant improvement, dropping to 5.8% on a consolidated basis compared to the previous 6.3%. Similarly, on a standalone basis, the ratio decreased to 5.6% from the previous 6.3%. These decreases in the percentage demonstrate our steadfast dedication to optimizing operational efficiency and resource allocation throughout our operations. Likewise, our cost-to-income ratio improved to 45.4% as against the 56.5% on consolidated basis, and on standalone basis stood at 42.6% as against 54.3% in the previous fiscal. On the borrowing front, this year we have logged 39% increase on year-on-year basis and raised 9,494 crore from various lenders on standalone basis. Additionally, the company added 20 new lenders. We draw good comfort from our diversified liability profile with continued access to funds from domestic and international lenders, improved credit rating, also well-capitalized balance sheet to maintain sufficient liquidity, and strong control on our borrowing costs. Delving into our robust capitalization endeavor, we have successfully completed 15 rounds of capital raising since 2008, culminating in a remarkable sum of 1,537 crore, out of which 595 crore was raised post-COVID-19, the last round being QIP of 250 crore done in December 23. As on March 24, the company has ample liquidity of 1,100 crore and has a healthy CRAR of 27.7%. Sharing our perspective on the ongoing KYC issues in the industry, I would like to say that in light of increasing digitization, landscape is evolving rapidly. However, along with the myriad benefits, also emerge significant challenges that demand vigilant attention, particularly in the realm of security. One such challenge is the rising occurrence of authenticity of KYC. At Satin, we take pride in upholding the highest standards in our internal processes in authentic customer onboarding. Rigorously adhering to stringent guidelines and protocols has been integral to safeguarding our customers' operation and maintaining transparency. With strong underwriting capability and bringing in cutting-edge and new-age technologies to onboard our customers, such as iris-based verification, geotagging, e-signatures, etc. We strive hard to rule out instances of fraud, non-compliance, and other potential issues. Through strategic investment in our robust IT infrastructure, we are not just safeguarding our business operation, we are paving the way for enduring growth and triumph in ever-evolving digital realm. Over the past 2 years, our relentless pursuit of digitization has yielded tangible results. For instance, we have witnessed a remarkable reduction in our branch manual registers from 20 to just 6, which has led to a more streamlined processes and enhanced efficiency. With a very strong uptime of 99.6%, which translates into a very strong tech advantage, this combination of technological advancement and operational excellence propels us forward, ready to thrive in today's dynamic business landscape. Like I said in the beginning, this year has proven to be a success for us and has demonstrated our resolution to excellence. We earned multiple laurels for our processes, compliance, innovation, and consistent strong performance. To name a few, our company was awarded with the latest standard of ISO 27001:2022 for information security. We have received the highest rating and AA ESG rating and gold level certification on client protection principle. We were recognized as Great Place to Work for the 5th consecutive year and top 50 Great Places to Work 2 years in a row, amongst others. Going ahead with an extensive reach spanning pan-India, a distinctive operating model, a diversified product portfolio in secured and unsecured lending, a robust technology infrastructure, seasoned board and management personnel, a diversified liability profile, a resilient business model, and a strong balance sheet. We are poised to be at the forefront. Our aim is clear: to be the ultimate one-stop financial services provider, primarily in the rural India, differentiated by our process and technology, and to emerge as a preferred financial ally for millions of underserved low-income households. Now, let me run you through the financial and operational highlights of our company. Starting with consolidated highlights. We have a customer base of 34.7 lakhs as on 31st March 2024, with presence across 1393 branches and 421 districts of India. Our top 4 states contribute to 56% of total AUM in FY24, and the states are UP, Bihar, West Bengal, and Madhya Pradesh. The total revenue for the year stood at 2,241 crore, up by 44% year-on-year. Standalone highlights. The average monthly disbursement run rate is about 808 crore. Our average ticket size of MFI lending for FY24 stood at 47,000. We have a well-diversified customer base of approximately now 34.4 lakh clients with 76% rural exposure. 54% of our clients belong to first cycle as of March 24. We have added 158 branches during the year. PAT for FY24 is at 423 crore, ROA at 4.8% and ROE at 18.5%. Net worth stood at 2,667 crore as on 31st March 2024. Total borrowing stood at 7,269 crore as on 31st March 2024. Debt to equity ratio stood at 2.7x. As on 31st March 2024, 96.4% of our districts have less than 1% of portfolio exposure. In our constant endeavor to enrich our customer lives, we provide financing of various products, which includes loans for bicycles, solar products, home appliances, consumer durables, and water and sanitation facilities. An update on subsidies. Through the collective efforts of our subsidiaries, we aim to extend a spectrum of financial services to our clients. By harnessing the strength of our microfinance outreach, we endeavor to extend affordable housing and retail MSME loans specifically to clients who have completed more than 2 loan cycles with the company and have higher credit requirements. This approach aligns us with a broader strategy of customer life cycle management. By servicing microfinance graduated clients, we are not only deepening our relationship with existing clients, but also capitalize on their evolving financial needs and capabilities. Satin Housing Finance Limited has now reached an AUM of 756 crore, which grew by 50% year-on-year, having presence across 4 states with 7,456 customers. SHFL has a 100% retail book. The quality of portfolio remains intact with GNP of 0.8% as on March 24. The company has 26 active lenders, including NHBD Finance, CRAR of 49.2% and gearing of 2.2x. PAT for FY24 stood at 9 crore. Credit rating of A- stable from ICRA. Satin Finserv Limited, the company's MSME lending arm, has reached an AUM of 501 crore. We are running down the business correspondent book and focusing on building MSME retail book going forward. CRAR of 48% and gearing of 1.4x. PAT for FY24 stood at 5 crore. Credit rating of A- stable from ICRA. In summary, as we progress on the path of expansion, we are poised to embrace greater profitability while upholding cost efficiency. With this, I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Usha Toshan from Toshan Investments. Please go ahead.
Hello.
So may I request you to use your handset, please?
On behalf of Usha Sharma, I am Prabhudayal Sharma. Sir, good morning.
Good morning, please.
Hello. Sir, congratulations for presenting superb performance on all fronts. I have some questions.
Sorry to interrupt you, sir. May I request you to use your handset, please? Your audio is muffled, sir.
Hello. Hello.
Yes, sir, we can hear you.
Please go ahead.
Sir, congratulations for presenting superb performance on all fronts. I have some questions. First, sir, our cost of funds always higher by around 100 basis points with compare of industry leader, while our credit ratings is at par. Why, sir? Second, as you guided 25% CAGR growth till 2028, are you sure we will able to achieve 29,000 crore AUM by 2028 and 25% secured book out of 29,000 crore AUM? Sir, finally, sir, congratulations, you got India's most trusted leader award during the year. But I think the market still not trusting or our past come across when we see the real value or market cap of the company. Thanks and best of luck, though. Financial year 2020.
So let me piece it one by one, basically. So on the cost of funds, on the rating, I think, we've got an upgrade, technically. I think COVID had whatever reasons it had in terms of, whatever the rating agencies could probably look at. But I think with the robust performance coming in now for the last, I think about 10, 11 quarters on a trot, I think, my sense is that, this will keep on improving, We've had success a little bit on our cost of borrowing, definitely, yes, But if you really ask us, it's a constant feature, it's a work in process which happens practically every time when we go in. And we've been able to have a slight reduction in our cost of funds, definitely, yes, which is close to about 30 odd basis points, and definitely I think, this is going to be a feature which is probably going to be with us in the future. On our achieving a guidance on 25% plus, we are very, very positive, and we are very sure that we'll be able to achieve a 25% guidance of all the factors mentioned above. In my own speech, where I said, if you look at the macro condition, they are very conducive. If you look at the range of the branches which you have in territories where there is lesser penetration, I think, that is an advantage which we hold very well. For us, foraying into 2 new states, I think, we've done wonderfully well by keeping our operating efficiencies better, as well as reducing our exposure not beyond 1% in majority of about 97% of our districts, whichever is there. So I think, a culmination of all that, put together will probably give us that advantage. That 25% plus for us is not even a slightest of challenge, moving forward ahead. On the third, in terms of the market cap, I think probably I'm not the best person to give you an answer on that. I think, it's for people to really decide, but my only, take on this is that, we've actually performed very well, if we look at the complete data which we've given in terms of our resilience, in terms of our profitability, in terms of our growth, in terms of our asset quality, in terms of, I would add, our technological advantage which we have, So when, for us, onboarding of a customer from a start of our onboarding of a customer to probably getting money from write-off books, I think, we've done it all, It is all a function of the market to really look at it. But I may add on to this, beside microfinance, I think, we've got 2 babies which are coming up, which are becoming very, very strong now, which is our subsidiaries of Satin Finserv and Satin Housing. I think, it is only a question of time when people will actually be able to realize the ultimate benefits of these 2 subsidiaries when they come up the fold on a bigger scale, And I think, for us, this is the advantage which we carry as an institution with microfinance and 2 of our secured lending subsidiaries of Finserv and SHFL. I hope I've answered all your questions.
Thank you, sir. Thank you.
Thank you. A reminder to all participants, ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Sameer Bise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on good quarter. Can you share the write-off amount for 4Q?
Quarter 4, the write-off amount.
24 crore was the write-off amount in Q4 FY24.
Okay, and any details on what portfolio was it? Was it the pre-April 21 book or any specific state?
So actually, when we write off, we actually take, because see, our slippage is so less, we actually do account by account feedback from the team, where they have exhausted all their efforts and they give up. So majorly it is 360 plus and above, but sometimes we even take a call when it is earlier, when the field team gives us that feedback.
And just to add, wherever we don't write, we make adequate provisions. Our provision coverage ratio is 83%. So wherever sort of say we have taken a call, but it has already been provided for.
Okay, thanks. Secondly, if you could disclose the stage 1 and stage 2 provisions, may not be this time around, but as an ongoing practice, it will be great. If you could share the numbers, that will be helpful.
I think we can share the numbers with you basically offline, but a point taken, I think we'll be able to, we'll show that also now.
Okay, yeah. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Nikhil Agarwal from VP Capital. Please go ahead. Mr. Nikhil Agarwal, may we request you to unmute your line from your side, please?
Okay, can you hear me now?
Yes, sir, please go ahead.
Okay, hi, thank you for taking my question. So, congratulations on good numbers on all fronts, except there's one clarification that I need on provisions. With regard to this Punjab book, now this quarter we were expecting that it would come back because the affected areas and the affected amount of portfolio was really very low, which was around 14-15 crores. And out of that, we have already seen, as stated in the presentation and as explained earlier, we have already seen 11 to 12 crores of impact. So going forward, are there any other issues that we're going to see? Is this going to be repetitive? And again, on the write-offs portfolio, if you could just give some clear view on where these write-off books have come from.
So on the Punjab portfolio, I think, if I can give you a flavor, the PAR 1 has remained steady at about 20 odd crores, 23 crores, since the last 3 to 4 months, So if you look at the deterioration in these 10 branches, I think that has not happened. So no fresh new PAR is coming in. It's only that the flow which is happening in this, in the 90 plus, that is probably which has been there, and that which is also, if you really look at the overall scenario, I think in terms of the complete balance sheet side, this is practically insignificant. So that's on that, Write-off is, there's no specific write-offs. Technically, write-off is a function of, what the field technically says that, they'll not be able to collect, as well as, a function of maybe somewhere a DPD. Overall, it is practically, it's everywhere. We pick up, wherever it is not coming in. So it's not very state specific as such, if that is what you really want to know. And there is nothing in terms of, looking at, we do it case by case basis, with consultation with the operation team,
All right. And so with regard to PAR 90 plus flows, because of which we have seen stress in the Punjab book, those PAR 90 plus flows have also elapsed, or there's more there? Because I understand that PAR 1 plus we are not seeing any inflow or any fresh stress. But in the PAR 90 plus flows which are back-ended, is there any more impact left?
There's nothing, if you really look at it, the PAR 90 is closer to about, I think, 13 or 11 crore. No, my 11 crore, if you look at PAR 1, which is 23, inclusive of that 11 crore, what you might have maybe in addition, going forward would be another maybe, 5, 7, 8, 10 crores, which will probably come in, which, as I said, if you look at the complete construct of the overall credit cost and this thing, my credit cost is 1.44%, I think, which is probably pretty healthy, looking at whatever is going on in the entire country in terms of, how microfinance is shaping up. I think, my sense is that this board, that there has been an effective stoppage of, probably the flows into the, even in the Punjab circle as such,
Got it. That gives great clarity. The 7-8 crores that you're saying that might come, whatever number it is, 5 to 10, is it again gradual, or is it a one-time thing that comes? So does it hit the book suddenly, or like 1 quarter thing, or is it staggered over 2-3 quarters?
I sense it could be staggered over 2 quarters as such, basically. But I think, it's a very low number, as compared to what people's apprehension was on Punjab portfolio. So I think, even if it's staggered across, maybe it'll be about 5-7 crores per quarter as such, at max.
Got it. Thank you so much. Also, can I ask one more question, please?
Please go ahead.
Okay. One thing, we have the highest operating expense ratio in the space that we operate in, all right? In the MFI space. So I just wanted to know, since this quarter has been...
Sorry, Nikhil, you need to check your facts. We don't have the highest. In fact, we're closer to probably the lowest.
Yeah, so we are what everyone is, barring the largest player in the industry. Practically, if you see another competitor declared their results, their OPEX is 6.6. And ours is actually at the average and at the lower spectrum of the average, barring the industry leader.
Okay, I'm looking at I'm looking only at the standalone MFI book, and I'm comparing with the top 3 players.
That is what I'm referring to, the standalone book. Okay, let's talk the last quarter numbers. In last quarter, we were actually at the lower end of the spectrum when we look at the OPEX of, I said, except the industry leader. Rest everyone is from 5.8 to 6.2%, and we were at again 5.8, 5.9%. If you talk about last quarter, is where we are.
All right. And are we doing anything specific to bring this down? Is there a timeline when operating leverage is expected to kick in? And
this is work in process. This is work in process. Our endeavor always is to bring the OPEX down, to bring in more optimization, and with the denominator base increasing, I think, we will be able to achieve something or the other, in the OPEX, coming down.
So we have actually given a slide on the operating efficiency, and if you see, we have actually achieved more than 25% operating efficiency on the existing setup, whether it is the branches, loan account per loan officer, or the clients per center, etc. This is how our One is this, and second, of course, is the base effect, which takes it into, I'll say,
There is significant improvement during last financial year, and we are on the lower end of the guidance that we have given. And then we are sort of say committed to work harder and then sort of say improve it further. But you see the improvement from last year is quite significant.
Yes, that is perfectly visible. Congratulations and thank you. That's all.
Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Siddharth Oberoi from Prudent Equity. Please go ahead.
Yeah, hi. So this is a fantastic set of financial numbers that you've announced. My query is on the AUM growth. So you see, you've been growing for the last few quarters at 30% plus. The disbursement also 30%. So is this some pent-up demand that has come up, or is it? Do you think this is sustainable going forward?
Siddharth, I think, as per our guidance, for us, we've given 25% plus, and our forays into under-penetrated states and as well as, taking on new states along with the existing borrower base, and the deepening of geographical presence in under-penetrated states. I think for us, a 25% plus growth is absolutely a no-brainer, to be very honest. In fact, for us, the achievement always has been to try and beat that, and definitely I think we've beaten this, this year we'll probably be able to do that.
And just to add to why the 25% growth is a no-brainer, even if you see this year, the growth in clients is more than 22%. And so actually it's a very sustainable organic business volume growth. It is not merely on account of the ticket size, which is not growing as much as the overall growth. Just another comment.
So is it any particular region, or is it all the 26 states?
Across, I'm glad you asked this question, because when we got the market study done, when we did our QIP, we actually saw that we are actually present in under-penetrated or lesser penetrated geographies across the industry vis-a-vis our peers and competition. For instance, states like UP, states like Assam, states like the central part of India, etc., are barely two-digit in terms of the penetration. But if you look at the overall addressable population, there is a huge pent-up demand, and we are also seeing even the industry is taking note of it, and they are also wanting to go to these under-penetrated states away from the original hub of microfinance, which was southern India.
Okay. All right. So basically that was my question, that if this loan growth is sustainable, then, so ballpark, do we expect something like a 14,000 CR AUM, probably for FY24-25?
So that anybody's guess, but we'll try and touch to be closer to that, for sure.
All right. Sure. All right. Thank you so much. Yeah.
Thank you.
Thank you. The next question is from the line of Shreyans Jain from Electrum PMS. Please go ahead.
Good morning. Congratulations on a great set of numbers. I have one question. One of our competitors mentioned that there is a Karza Mukti Abhiyan happening in Rajasthan and MP as well. So, are we seeing some stress there, or what's the situation on the ground there?
To be very honest, we haven't seen any stress because of Karza Mukti Abhiyan in Rajasthan as well as MP. For us, it's business as normal.
Okay, so no impact, zero impact, right?
No, not at all.
Okay. Thank you so much.
Thanks.
Thank you. The next question is from the line of Amit Agarwal from Water Equity. Please go ahead.
Thank you for the opportunity. So my question is ties to somebody just said that, Satin seems to be present in more of under-penetrated or unpenetrated districts. I just wanted to understand this 57% loan one customers. I'm assuming it's for Satin loan one and not new to credit. So my one question is, what is the breakup for 57% in terms of new to credit and, new to Satin from older MFI? And my second point is, do you do risk-based pricing for these customers who are into higher cycles, who are matured? So is there any mechanism for risk-based pricing? Thank you so much.
So hi, this is Aditi Singh. So in first cycle, while there are 55% first cycle customers for Satin for every incremental disbursement, 18 to 20% are actually new to credit. So that was your first question. And we are actually we have now introduced risk-based pricing for the subsequent cycles. So this has been done effective April.
Yeah, 1st April, yeah.
What is the approximate benefit you are giving to customers, if you can disclose that?
Sorry to interrupt, sir. We are unable to hear you. May I request you to use your handset, please?
Yeah, sorry. So I'm asking, what is the incremental benefit you are giving to the subsequent cycle customers? So that is fine to disclose.
Technically, overall, it becomes about 40 basis points, lesser than, from where we started.
Okay, that's helpful to me. Thank you so much. Thank you.
Yeah.
Thank you. The next question is from the line of Ronak Singhvi, who is an investor. Please go ahead.
Yeah, congratulations for a fantastic set of numbers. I just wanted to understand. So yesterday, RBI basically came across with a note on the unfair practices in charging of interest. I just wanted to check if this Satin is not following any of those practices, just from a comfort perspective.
No, so there's absolutely no impact of that circular on Satin. We electronically disburse all the loan, and the interest is charged from the time it is credited to customers' accounts.
Okay, thank you. The another question was basically on the provisions and the gross NPA. What is the legacy Assam book, which is still sort of lying in the gross NPA, and any status update on recoveries from the government?
So the old book is close to about 60 crore, which has adequately been provided for. The discussion with the government is on through the industry association. It's slightly challenging to commit a timeline, but there's no indication that will not happen. It's only a question of time.
Okay. Thank you. These are my only questions.
Thank you. The next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Hello. Hi, sir. Good morning. Sir, what is our guidance in terms of ROA and NIMs for this year? We have very well surpassed our previous guidance. So now, how do you see it shaping up for the rest of the year now?
So NIMs, I think we are guiding at about the band which we have given earlier is about 12.25% to 12.75%. And the ROA, the guidance is at about 4.25% to 4.75% for FY25.
So, for FY24, I believe you have done much higher than that, correct?
Yeah, but we always are very conservative.
Okay, so you're sticking to the previous guidance and then...
so we're sticking to the previous guidance. Yeah, we're sticking to that.
And when it comes to the growth you're expecting, you're saying it's a no-brainer. So do you see it happening more from the in terms of client addition or from the geographies in which you are present, or it's a mixture of both? So
it's a mixture of both. Yeah. No, it's always a mixture of both. Always a mixture of both.
Okay. Okay, all right. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Chirag Fialo from Ratnatraya Capital. Please go ahead.
Hi, good morning. Thank you for the opportunity. Congratulations on a good set of numbers. Just two clarifications quickly. What was the gross slippage for Q4 and for the year?
Give me 1 second.
No, thank you.
Just give us a minute.
So in Q4, the slippage is close to about 60 odd crore, and for the entire year, including something has already been written out of that, was about 140 crore. There's a gross slippage.
Understood. So So 70 and 140 for the year. 60 and 140 for the year, sorry.
60 and 140. The slippage is to 90 plus.
Got it. And could you just talk about sort of, how do you think from here credit costs will evolve for the next 12 to 18 months? Broadly, what are you seeing on the ground, and what do you think we'll end up at the end of, say, 25, 26?
See, our guidance is still, which we had given for the credit cost was at about 1.5 to 1.75%. We did about 1.5. I think, maybe early days is yet, but we feel that it's gonna be stable within this guided range of ours, of 1.5 to 1.75%, That's what our thought process. And looking at the ground, I think, we're just waiting for the elections to finish off. And once that finishes off and the results come out, I think we may relook at it basically. But as of now, currently, we look that this is going to be within the guided range in itself,
Understood. Thank you so much.
Thank you.
Thank you.
The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on good set of numbers, and thank you for the opportunity. So my question again is related to ROA at more on a consolidated level basis. So looking at a more, 3 or 4 years down the line, what is the steady state ROA that we can achieve?
See, for us, we did an analyst meet, and I think, for us, a steady state, including Concall and everything, for us, would be again in the range of about 4.8%, or so. That's a steady state, which we are trying to look at. So we'll be within that range of about, let's say 4.8 to, let's say 4.9 or 5,
Yeah.
I think it's gonna be within that, realm,
So this includes, this is at the consolidated basis, right?
Yes. Yeah. Absolutely.
And what would the number be for ROE?
ROE would be, I think 20% plus, for sure. We've done 18.5% this year. My sense is, I think, for us, looking at the capital adequacy, profitability, ROAs and everything put together, I think we'll always be 20%, 20% plus, Could be in the range of 21, 22%, I think that is what our effective consolidated guidance is.
Okay. So at this, the growth rate we are targeting 25% or even more than that. So what would be the mix of the off-book lending and to the total AUM? What would a number, if you could share with us?
So I think, for us, we are dropping our off-book, slowly and steadily year on year. I think, a year before that, it was closer to about
29%.
29%. We are down to about 23% now. For us going forward, we would be bringing it down to, I think, closer to about 20% or lower than that, in the next couple of years. I think it's gonna be below 20%, for sure.
Okay. Okay, sir. That's all from my side, and all the best.
Thank you, sir.
Thank you. The next question is from the line of Suryansh from BizX Enterprise LLP. Please go ahead.
Good morning, sir. Congratulations, sir. My question was that what is the average cost of borrowing and versus like incremental cost of funds? This was my question.
Just 1 minute, yeah.
So marginal cost of borrowing is closer to 11.5% or so. We've got the rating upgrade only towards the beginning of last quarter. We have started getting some overall success there. The blended cost will come down over a period of time.
Okay. And will we go for capital raise in near time, or we have done whatever we have to raise?
See, looking at 25% plus growth and the capital adequacy right now, I think, we don't have any kind of thought process of going for any capital raise, in the immediate future.
Okay, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Agastya Dave from CAO Capital. Please go ahead.
Am I audible?
Yeah, you are.
Good morning, Singh sir. Congratulations on great set of numbers. So I have a few questions. So first is a follow-up on what Aditi ji was saying in terms of penetration levels. So Aditi ji, how are you defining this penetration level? You said that UP is just double digit.
So, Agastya, this is actually done on the basis of the total addressable households who are below a certain income level and how much households have availed any formal credit, including microfinance.
So pan-India, how much would you, like, what kind of number would you ascribe to this penetration based on this?
While we do not have pan-India, what we have seen from that CRISIL report is Tamil Nadu and has the highest, around 60-65%, followed by states like Bihar and Karnataka at around 55%. So this is what the high penetration is. Around 60-65% is the highest across the industry.
And when you said UP is double digit, you meant like 11,
UP is 17 to 18% is the number for UP.
So let's say the comparison, UP is about 17% penetration as compared to these higher states of about 60-65%. So that's the difference.
Right. And so individually, if you look at like across geographies, what is the if you compare it households of Tamil Nadu with UP, I'm pretty sure the propensity to borrow would be different, and the amount to which they are comfortable borrowing, that will also be different. So if you just do a household by household comparison, what would be the relative size of UP with respect to, let's say, Tamil Nadu or Andhra Pradesh?
So size in terms of number of people or income level?
No, I'm saying the extent of, let's say, income level or the borrowing levels. Like for example, in Tamil Nadu, probably you can give 1 lakh rupees. In UP, can you give 1 lakh rupees? That is the question.
Actually, it is the opposite. In UP, we can give more because after the HHI norms, etc., what we can actually lend to a household, we are restricted in southern India. The rejections are high by at almost 65-70%, while the rejections in UP are 20-odd%. So uske karan se, and the thing is, repaying capacity across India people have in microfinance. So I would say 90-95% in people of microfinance borrowers do have the repayment capacity.
And just to give you a flavor, Western UP is probably the highest in terms of income generating levels, as compared to probably, most of the states,
True. Sir, another thing was that I remember many years back you started your cashless initiatives for disbursements as well as collection. So what levels have you reached today? And in terms of the process of driving this cashless disbursements and collection, how do you do it? Is it like, do you have a nodal bank where all the accounts are linked to that bank and the transactions happen through one nodal bank? Or are you more diversified and you go to a particular customer and a particular borrower, and if they have, say, in SBI, then you transfer the money to SBI. If they have in Canara Bank, you will do it to Canara Bank. How exactly is it structured?
So we are bank agnostic, in terms of our cashless collections. For us, we've got, the methodologies of our website, QR code, as well as app and everywhere, and UPI coming in, across over there. So that which ways, if you look at it pure cashless, without us touching money, is about 10%. Now, when we talk about cashless collection, I think, for us, what is more important for us is the customer to be there in the meeting. And normally we've seen that if a customer actually goes through a cashless mode of making a payment, for her, attending a meeting is kind of, they tend to avoid the meeting. And we don't want that, That's the reason why for us, the model is based upon a customer connect and the rapport with the customer. And that's the reason why for us, this has remained at about 10%, and we would like the customer to come to the meeting, have a physical presence, and the interaction with the loan officer probably gives us more insight in terms of the portfolio quality and the credit asset quality as such, But to add up, for us, all the cash is handled by our agencies, which already do cashless collection, is technically cashless collection through their associates, which are being done. So normally for us, our boys only bring the cash to the branch, and the rest everything is handled by these cash crop agencies, which do it.
Great.
And probably you mentioned about disbursement also. Sorry, you mentioned about disbursement also. For last many years, we have been doing 100% cashless disbursement.
So I asked this question because RBI recently has been imposing several restrictions on individual banks, citing whether IT-related issues or compliance-related issues. So if it may not be your fault at all if you are heavily concentrated to one nodal bank, and if they find something wrong in that bank's processes, your disbursements may get hit. So that is why I asked this question. Is there a risk to that?
Agastya, I don't know whether you heard my speech. For us,
I did.
The acquisition or onboarding of a customer is absolutely very, very faultless with authentication of KYC from an iris mechanism, which I think is getting introduced in banks now. So over there, we are just saying, so we actually have no problem, if we, could be a problem of a bank, which we've got several banks, which are lined up, so we don't have a problem with
There is not a single bank.
There's not a single bank, there are a lot of banks, basically, whom
we tied up for disbursement.
More importantly, is the onboarding which we do ourselves. Yeah.
So may I ask one more question? Otherwise, I'll go back in the queue. It's a tiny question.
Yeah, tiny answer then. Please ask me.
So, are you seeing any slowdown because of the elections in Q1? Because this time around, it is a very prolonged election where, like, there is a lot of disruption at the ground level. So any impact that we can expect in Q1 in terms of, like,
maybe a little bit in terms of disbursement, but I think, added to disbursement, this whole season is all about harvesting. Its whole season is all about marriages. The whole season is all about technically, people not being available because of various factors of, festivals being there, So we had all these Baisakhi, Bihu, Bengali New Year, everything, So I think if you put all that culmination together, it'll be slightly slower in terms of disbursement. But I think, my sense is that when May comes in, I think we'll be able to bounce back in the normal parlance as such in terms of disbursement.
Thank you very much, Aditi ji. Thank you very much, Singh sir. All the best for the next quarter, sir. Thank you.
Thank you, sir. Thank you so much.
Thanks.
Thank you. The next question is from the line of Prathamesh Sawant from Axis Securities. Please go ahead.
Thank you, sir. Congratulations on great set of numbers to Satin and the team. So my question is with respect to, sir, that we are seeing in the last 2-3 years that the overall NPA levels have been going down throughout the industry. So I just wanted to understand from your piece of experience whether it is because of the political stability that has been coming around in your key markets, and given that we are seeing that the same political stability to continue for the next 5 years, do we see this kind of NPA numbers for the next 5 years, or is it just we are at the good end of the broader cycle? So I just wanted to have what are your insights on this?
See, I'll be very apolitical when I answer this. Definitely, yes, the stable environment does add on to the NPA levels going down. But having said that, I think for us, the more focused as an institution we are towards asset quality and credit costs, I think the underwriting capabilities actually come back to the fore, which is more important. So I think stability does add to it. But I think, more than to it, and that's what, we as an institution are trying very hard to do it, to maintain our underwriting capabilities, augment our underwriting capabilities, look at customer acquisition through all the lens, and that's the reason why we said that for us, iris verifications and all that acquisition and everything gives us maybe a slight edge in terms of how we are able to do the acquisition and the underwriting of a customer, moving forward. And that'll be a significant thing, which we really want to really concentrate upon and look forward to.
And sir, largely, again, most of my questions have been answered. So just one broader question on, the structural nature. What are the 2 or 1 biggest risk that you foresee in, coming?
Yeah, it doesn't tell you when it comes, but as an endeavor for us, we are always, on our toes to really look at, probably, the ways and means how to do it. And just to give you that example, for us, Punjab came in, without even this thing, but since we have capability in our technology, in our data, in our underwriting, and we have a capability which we feel is sufficient enough, we were able to contain the damage in Punjab much better than, much better than what, the industry has been talking about. I think, that's probably the answer which I can give you.
Do you see any structural overhang where, RBI comes in, controlling on the rates that the MFI space has been doing. So do you foresee that as a risk?
See, that's not a risk. That's a collaborative effort, where the RBI would definitely love us as an institution to probably give a lower credit, cost, lower credit, output to our borrowers, and definitely, and we are all moving towards that. So the reason why we've done risk-based pricing and looking at a 40 basis point reduction from 1st of April definitely is something, where I think, it's been a collaborative effort with RBI and all the MFIs put together.
So wouldn't that have an impact on, target ROAs and ROEs going in?
No, it won't. You've seen our guidance. You've got other ways to probably, cut down on this thing. You can cut down on your OPEX, you can look at credit costs, you can look at cost of funds. Too many features, which can probably be there. So any reduction in ultimate cost will be coped up with, 5 other factors which will probably be able to give you that kind of answer.
Okay, sir. Sounds great, sir. Best of luck for your future.
Right, sir. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Ms. Aditi Singh, Head Strategy, for closing comments.
Hello, everyone, and thank you so much for taking time to come on this call, for all the engaging questions, and for all the trust you have shown, for all the support. We have tried to answer all of the questions, and still, if you want any further follow-on discussions, you can reach out to me or my colleague, Ms. Shweta Bansal, from the Investor Relations team, and we'll be more than happy to discuss and share more perspectives on any topic you want to discuss in detail. Have a great day, everyone. Thank you.
Thank you. On behalf of Satin Creditcare Network Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.